Good morning and welcome to the Bulls, Bears, and the Bella Morning edition of The Deep Dive. I'm thrilled you've chosen to join us this Thursday, October 2nd, 2025. Look, if you are trying to make sense of the market setup today, well, you have definitely come to the right place. We have spent the last few hours really digging into the pre-market intelligence report and the daily market movers. We're doing a deep dive into what our sources keep calling a complex and dichotomous trading environment. Our mission today, really, it isn't just to relay the news. It's more about giving you the mental framework, the map that you need to navigate these conflicting signals and, frankly, the extreme volatility that really characterize this market right now.
It really does feel like two completely different markets operating at the same time. I mean, on one hand, you've got the broad indices, right? The S&P 500, the NASDAQ. They're moving almost entirely based on, trying to read the Federal Reserve's tea leaves. And this behavior seems pretty detached from the underlying economic reality. But then on the other hand, you see this absolutely explosive, highly speculative activity bubbling up in individual stocks. It's driven purely by narrative, by massive capital flows sometimes. So the core conflict here, and maybe the central aha moment we really need to grasp right now, is the psychology that's driving that large cap movement. We're just dominated by an inverted reaction function. And honestly, until you internalize this concept, you're probably going to misread every major data release that comes out today.
Right, it's like the bizarre world economy, some might call it. This classic paradox where, bad news for the actual economy is currently being traded as, good news for asset prices. The tough part, I think, is really understanding why this dynamic, this hunt for accommodative policy has just completely hijacked the market's focus. It seems to be overriding, pretty much everything else. Okay, let's really try to unpack the mechanism behind this bad news is good news idea. Because, it really goes against everything generations of inventors have been taught. Why is the market so fixated, almost obsessed, with the future path of Federal Reserve policy? So much so that it seems genuinely, maybe even willfully, blind to these looming immediate risks, like a potential government shutdown.
Well, the answer is pretty simple, really. It's liquidity. Pure and simple. And the perceived availability of, cheap capital down the road. The market seems to have fully internalized this psychological mechanism, often called the Fed put. It's this unwavering belief that if economic conditions really deteriorate significantly, the central bank has to step in. They must intervene to prevent a crash. So economic weakness, you see, isn't viewed as a threat to corporate earnings in the long run. Instead, it's seen as an immediate catalyst for potentially aggressive interest rate cuts. Every single piece of negative data gets immediately reinterpreted through this policy lens. The question becomes, does this weak number increase the probability of rate cut? And if the answer is yes, well, then that perceived incoming wave of cheaper money, that increased liquidity, it's seen as a far greater positive driver for asset prices than the negative implication of the weak data itself. And this dynamic, it creates a really powerful floor sort of for risk assets.
Yeah, the resilience we're seeing right now is maybe the perfect, if slightly terrifying, illustration of exactly this. I mean, the threat of a U.S. government shutdown isn't just hypothetical, right? Our sources say federal officials have actually deemed it probably likely. Mm-hmm. Historically, you'd think this level of political dysfunction, this uncertainty, would send futures tumbling straight into the red.
Oh, absolutely it would. I mean, a government shutdown means real economic disruption. You're talking delays in processing visas, halts in non-essential government services, and, a measurable drag on GDP. Yet, look at U.S. futures this morning. They're holding modest gains. Why? Well, investors aren't focused on the economic hiccup itself. They're focused squarely on the policy response. The argument seems to be that if political gridlock causes even, minor economic disruption, it only strengthens the hand of the more dovish members of the Fed. It's sort of compels them to ease sooner. So they view the shutdown not really as an event in itself, but more like a supporting piece of evidence for that dovish narrative they want to believe in.
It's a remarkable level of cognitive dissonance, isn't it? Filtering potential real-world disaster purely through a policy expectation lens. Mm. And that policy expectation, this is dramatically cemented by that labor market data we got just yesterday. The ADP private payrolls report, that was a real shockwave.
Oh, it absolutely was. That report became the centerpiece, really, of the dovish argument we've seen solidify in the last 24 hours. The consensus expectation among economists was for a modest but still positive gain, right? Around 51,000 private sector jobs in September. But what the report actually delivered was a completely surprising loss of 32,000 jobs. Now, that's an 83,000 job swing, deviation from consensus expectations, and the market sees that as a clear, immediate signal of, well, rapid labor market cooling, maybe even verging on outright contraction.
Okay, so a loss of 32,000 jobs is, definitively bad news for the underlying economy. It often signals recessionary pressures creeping in. But in our current bizarro world paradigm, how does the market translate this deep negative into such a powerful positive?
It's purely about leverage on the rate expectation curve. Our sources are indicating that the substantial negative ADP reading directly, quote, amplifies expectations for aggressive Fed rate cuts, potentially 50 basis points or more in November or December. Now, a 50 basis point cut, that's a dramatic move. It's far bigger than the small incremental cuts that might normally be priced in. So that expectation of future liquidity injections, well, it's weakening the US dollar, which is also, a bullish signal for international risk assets and commodities. And crucially, it provides a strong floor for US equities, essentially overriding the negative implication of the employment number itself.
But I have to challenge this a bit. I mean, if the market has already fully priced in this kind of dovish reaction, doesn't that make the entire strategy incredibly vulnerable? You, the listener, you really need to understand that this inverted paradigm sets up an immense amount of directional risk, especially today.
You're hitting on the critical point, which is sustainability. This strategy is entirely, completely reliant on continually receiving weak data. It needs bad news to feed it. And this means your intraday trajectory today is going to be hypersensitive to the morning's economic releases. And the reaction, crucially, will likely be inverted. So if the data misses consensus expectations to the downside, let's say initial jobless claims come in much worse than expected, the market will probably treat that as bullish. It'll rally, confirming that dovish path.
But here's the danger, right? And this is where, the nibble trader potentially earns their premium. If we get surprisingly strong data today, maybe a number suggesting unexpected resilience in the labor market, or perhaps in manufacturing, that could immediately challenge this whole dovish narrative. The market is positioned so heavily for weakness right now that a shock of strength could trigger an immediate, maybe aggressive, and certainly painful sell-off, because those aggressive rate cut expectations would suddenly get pulled back. You absolutely must be prepared to trade the opposite of what your gut instinct tells you strong data should mean for the market. Okay, so the stage is pretty clearly set. We've got two major data points coming up this morning that are going to immediately test the fragility of this bad news is good news thesis. Let's shift our focus now to the immediate catalyst on the economic calendar, starting with arguably the most critical one.
Yeah, market direction, and at least initially, is likely going to be determined at 8:30 a.m. Eastern Time by the release of initial jobless claims. This is a really crucial high-frequency indicator. Unlike the ADP report, which sometimes gets revised or, historically can be a bit less reliable, the jobless claims report tends to provide a more timely and often less skewed reading on the current pace of labor market layoffs and hiring sentiment.
So what are the key numbers we need to be watching for here? And more importantly, how is the market likely going to process the outcome based on this inverted logic?
Right. So the consensus forecast is for 223,000 new claims. That compares to the previous reading we had, which was 218,000. Now, the market, as we've discussed, is essentially hoping for a number that shows deterioration. It wants weakness. Therefore, for the market to maintain its current sort of bullish posture, for this rally to maybe continue, we ideally need to see a number that comes in significantly higher than that 223,000 consensus. A reading of, say, 230,000, maybe even 235,000. That would strongly bolster the cooling labor market narrative. It would reinforce the case for the dovish Fed and likely provide a strong immediate tailwind for equities.
Okay, so conversely, if jobless claims happen to fall back below that prior reading of 218,000, suggesting the labor market is actually, accelerating or tightening again, that's the immediate recipe for a macro-driven sell-off. Is that the risk?
Absolutely. That's the danger zone. A figure below 218,000 would be, I think, the clearest possible challenge to the current thesis. It would introduce hawkish concerns almost instantly, and you'd likely see traders quickly reprice their expectations for those November or December rate cuts, probably triggering an immediate reversal in risk assets. Heck, even a print that comes in exactly at consensus, right at 223,000, might even be seen as disappointing. Because the market seems positioned for a negative surprise, something to confirm the ADP weakness from yesterday.
Okay, so that's 8:30. Then a bit later in the morning, 10:00 a.m. Eastern, we get the secondary data point, factory orders. This feels like the industrial resilience check, maybe. What's the expectation there, and how does this piece fit into the broader narrative puzzle?
Yeah, factory orders give us insight into future manufacturing activity. Now, the consensus here calls for a pretty sharp reversal. A positive 1.4% month-over-month increase for August. That follows the prior month's rather concerning negative 1.3% decline. So this data point creates a potential complication, right? A surprisingly strong number here, let's say, maybe an increase closer to 2%. Well, that suggests underlying resilience in the manufacturing and investment sector. And that resilience, you see, directly conflicts with the notion that the economy is collapsing and urgently needs aggressive Fed easing. So if we get weak labor data at 8:30, followed by strong factory data at 10:00, we'll likely see some extreme choppiness. The market will be forced to try and reconcile two opposing signals, a potentially collapsing labor market versus resilient capital expenditure. This is a pretty common situation where volatility spikes as traders try to figure out which indicator the Fed is going to prioritize more.
Interesting. Okay, let's zoom out for a second. Look beyond the U.S. Open. Are we seeing broad risk-on sentiment globally this morning, or are the drivers still very localized?
Globally, the picture looks highly divergent, actually, which suggests local factors are really dominating the price action. Asia was pretty mixed overnight. You saw Japan's Nikkei 225 sink by about 1.05%, but then the KOSPI in Korea and the Hong Kong indices were actually positive. Now, this mixed picture was also complicated by constrained liquidity. You had national holidays in major economies like China and India. So those Asian moves might not be fully reflective of true underlying conviction, less participation.
Right, but the real headline story globally seems to be coming out of Europe, which has been decidedly bullish, particularly led by the UK, correct?
That's exactly right, and that's where the analysis needs some real nuance. The UK's FTSE 100 has been a massive outperformer. It surged past the 9,400 mark to hit a new all-time high, 9,446 points. Other major European indices are strong too, but here's the absolutely crucial distinction for you if you're trading U.S. markets. This European rally appears completely idiosyncratic. It seems driven by very specific local policy catalysts, not a broad global risk-on wave.
So the listeners shouldn't just see the FTSE hitting a record and think, okay, time to load up on the S&P 500. The catalyst doesn't really translate across the pond.
Exactly. Our sources make it really clear this strength is intensely sector-specific. The FTSE index is heavily weighted towards pharmaceuticals, right? And the rally was driven by a massive relief rally in some sector heavyweights. We're talking AstraZeneca, which surged, 11%, and GSK up over 6%. The catalyst was policy-related. There were indications that these previously threatened 100% U.S. tariffs on branded drugs might be eased or maybe significantly lessened. Now, these tariffs were creating immense uncertainty for these globally exposed UK firms.
Wow, yeah, that threat of 100% tariffs must have been absolutely paralyzing for those companies. Can you just quickly give us the context? Why were those tariffs even on the table?
Well, the tariff threat really stems from ongoing global trade tensions and also specific U.S. policy efforts aimed at addressing, drug pricing and trade imbalances. It's often associated with things like Section 301 investigations or broader efforts to encourage domestic manufacturing. But the mere possibility of a 100% duty slapped onto their core product lines, that would essentially wipe out their U.S. market profitability overnight. So the removal or even just the easing of that threat constitutes an enormous, really company-defining de-risking event for them. And that explains those massive 6% to 11% moves in those specific stocks. And given their significant weighting in the FTSE, well, that drove the entire index to a record high. So this strength is really about relief from trade war risk, not necessarily broad economic confidence translating globally.
Got it. Okay, so given this mixed global picture and the clear reliance on that 8:30 a.m. data here in the U.S., what does the U.S. Futures Board tell us right now? Are we leaning directionally ahead of the open?
Well, U.S. futures have pretty much spent the entire overnight session chopping around in a consolidative pattern. It really suggests a temporary equilibrium, a kind of holding pattern. We're basically balancing the negative macro headlines from yesterday, like the ADP miss with those dovish Fed expectations. It's creating this pause. The E-mini S&P 500 futures, the ESC 25 contract, they're holding a pretty tight range. The key technical levels you probably want to watch for a breakout following the claims data are very narrow right now. You've got support down near 6,756,000 and resistance up near $6,769. A breach above 6,769,000, especially on strong downside labor data, meaning higher claims, would suggest that dovish thesis is fully engaged in providing a tailwind. Conversely, failing to hold that $6,756 support, particularly after maybe a disappointing jobless claims print, meaning lower claims, could signal the first real signs of skepticism creeping in about the Fed's imminent easing plans.
Okay, so we've established the broad macro market is currently laser-focused on the promise of future liquidity. Now let's transition gears and dive into the micro market, because this space has been focused on, well, pure, unadulterated narrative and, frankly, rocket fuel in some cases. This segment really captures the extremes of the current market psychology. The wild euphoria on one side and the catastrophic failure on the other.
Yeah, we are definitely seeing exceptional, almost historic levels of volatility in some of these catalyst-driven microcaps. And this level of activity, it confirms there's a tremendous appetite out there for speculative risk. We need to analyze, why capital is flowing so rapidly into some of these, frankly, disconnected narratives right now.
Okay, let's start with the really spectacular stuff, the triple-digit gains we saw in what we're calling the digital asset pivot stocks. Tell us the story behind Chijet Motor, CJET, and Rival. RVYL.
Right. Case study one really highlights pure narrative chasing. So CJET, ticker CJET, this was basically a legacy automotive manufacturer, and it surged over 180% in the pre-market. The catalyst, a strategic transformation announcement, a complete pivot away from building cars into the digital asset custody and storage market. I mean, this is the definition of a company trying to shed its maybe troubled past by attaching itself to the hottest trend out there. And what makes this pivot so extraordinary is the capital commitment involved. They didn't just announce a new strategy. They announced they were expanding a previously proposed private placement from, I think it was $20 million to a staggering $1 billion. Now, that scale of committed funding for a complete business model overhaul, it suggests some major investors are betting very heavily on this narrative shift. Perhaps they're targeting, rapid regulatory or exchange compliance that would somehow validate this pivot quickly.
Wow, a $1 billion commitment for a company basically switching from a tough manufacturing sector to a highly competitive, highly speculative tech sector.
Yeah.
It definitely feels reminiscent of 2017 maybe, when every other company seemed to add blockchain to its corporate name.
Absolutely. It has that same kind of feel. And we see similar enthusiasm, though maybe not quite as extreme, in RVYL, ticker RVYL Day. That one jumped nearly 70%. Their driver is a definitive merger agreement. The key part is that the resulting combined entity will aggressively pursue a Bitcoin treasury strategy. And the merger partner has pledged to contribute over $30 million worth of Bitcoin directly onto the new company's balance sheet. So the market is immediately rewarding the acquisition of cryptocurrency assets, viewing it as a clear, decisive statement of direction for the company.
Right. So the lesson here for you, the listener, has to be that this level of speculative froth, while maybe exciting to watch, indicates a profound pocket of high risk. These moves seem entirely disconnected from current profit and loss, right? They rely solely on the hope that the narrative will eventually generate profitable operations way down the line.
Indeed. Yeah, while the short-term gains are certainly electrifying for those involved, this kind of speculative surge carries an exceptionally high risk for a rapid and severe reversal. It really shows the danger of chasing momentum when the underlying fundamentals are, well, absent or completely changing. The same capital that rushes in on the narrative can flee just as quickly, maybe even faster, the moment a new filing comes out or a news release fails to meet those now sky-high expectations.
Okay, now let's move to an equally powerful catalyst, but from a totally different angle, government intervention. This brings us to case study 2, Lithium Americas, ticker LAC. This stock rallied more than 30% based on a deal centered around U.S. industrial policy.
Yeah, the LAC rally is arguably the most significant micro-event today, mainly because of its broader implications. The company secured a restructured agreement with the U.S. Department of Energy, the DOE, and also General Motors concerning the Thacker Pass lithium project. Now, this lithium deposit is viewed as absolutely critical for the U.S. effort to onshore its electric vehicle supply chain and, crucially, reduce dependence on foreign sources, primarily China.
And the nature of this deal, the structure of it, is what's truly fascinating here. It's not just a government loan guarantee, right? We've seen those before. The DOE is actually taking a piece of the action this time.
Exactly. They are acting much more like a strategic venture capital investor, and this might be the new model we see more of. Under the terms of this deal, the DOE receives a 5% equity stake in Lithium Americas itself via warrants, and they also get a 5% economic interest in the Thacker Pass joint venture itself. So the U.S. government is no longer just, providing funding or backstops. It is financially aligning its own interests directly with these national security objectives.
So what here, for the strategic investor listening, seems profound. This signifies a really noticeable evolution in U.S. industrial policy. When the government itself becomes a stakeholder, it signals that the project is essentially guaranteed strategic priority. It likely means regulatory acceleration and probably stability of funding, too.
Precisely. This agreement acts as a massive de-risking event for LAC, and it establishes a potent, maybe brand new investment theme, which is that alignment with Washington's strategic objectives, think critical minerals, domestic semiconductors, green energy supply chains, can now serve as a direct sort of non-traditional stock catalyst, a catalyst that can potentially override traditional concerns investors might have about project finance risk or maybe geopolitical uncertainty. This could very well be a model for how the government intends to execute industrial policy going forward.
Okay, now in stark contrast to these policy-driven and narrative-driven euphoria trades, we have a catastrophic collapse, one rooted in the painful mathematics of microcap finance. Let's talk about case study 3, the dilution disaster at Cheer Holding, ticker CHR.
Yeah, this is the other side of the coin. Shares of Cheer Holding collapsed by more than 70% in pre-market trading, and the cause was deadly simple. The company announced an $8.5 million public offering. This is just a critical lesson in capital structure risk for anyone looking at microcaps.
And to really explain that scale of collapse, that 70% drop, we need to look at the math, right? Because the dilution involved was truly, truly catastrophic for existing shareholders.
It was almost mathematically necessary for the stock to fall that much. You see, prior to this offering, the company's entire market capitalization was extremely small, only around $2.3 million. So when a company with a $2.3 million market cap announces it needs to raise $8.5 million in new capital, well, that new capital is more than 3.5 times the size of the entire existing company value. Think about it simply. If you had, say, 1 million shares outstanding before the offering, and then you issue $8.5 million worth of new shares, maybe priced at $1 each, just for argument's sake, you suddenly have 9.5 million shares outstanding instead of 1 million. That massive issuance of new shares leads to catastrophic dilution for every single existing shareholder. Their slice of the pie just got dramatically smaller. The stock price collapsed because it was essentially mathematically necessary to reprice the shares to account for that overwhelming influx of new stock. It really demonstrates the acute immediate risk you find in these microcap companies that are often constantly scrambling just to find survival capital.
Okay, so that micro market activity, the soaring policy plays on one end, the dramatic dilutions on the other, it really tells us a story about where investor capital is being deployed right now, or maybe where it's fleeing from. Let's try to synthesize this now into maybe 3 actionable thematic currents that could influence trading, not just today, but maybe in the foreseeable future as well.
Okay, theme 1, I think, has to be the digital asset narrative resurgence. The explosive, really outsized gains we saw in CJT and RVYL, they confirm that speculative interest in the whole crypto and blockchain space is back. And it seems pretty aggressive right now. This is likely driven, at least in part, by that hunt for yield, that search for massive alpha, fueled by the expectations of cheaper capital coming from the Fed narrative we talked about earlier.
So beyond those 2 specific stocks, what should you, the listener, be watching for if this theme has legs?
Well, this kind of narrative often creates sympathy plays, right? So you should probably watch for increased volatility and volume in the more established crypto-related equities. Think about the miners, the exchanges, maybe the infrastructure providers. Capital is clearly searching for potentially exponential growth stories again, and these adjacent sectors will likely benefit from the halo effect, at least initially. Though, it's important to stress, they probably carry similar massive risk profiles.
Okay. Theme 2 builds directly off that LAC catalyst we discussed, U.S. industrial policy as a trading factor. The government's decision to take a direct equity stake in a critical mineral project really seems to solidify strategic policy support as a potential massive de-risking catalyst. This feels like a structural shift.
I think it is. This looks like a robust investment theme that might move beyond traditional market cycles. We're seeing a distinct trend emerge where companies operating in sectors deemed critical to U.S. strategic interests, domestic mining, rare earths, next-generation semiconductors, key components of the green energy supply chain, they're receiving powerful market validation directly from Washington's involvement. This really means that corporate alignment with federal objectives is now becoming arguably a fundamental part of the investment thesis for certain companies.
In theme 3, this seems like the consequence of all this macroeconomic and microeconomic activity converging, sector performance divergence. Given the weak labor data backdrop, but also the strong speculative appetite we're seeing, what parts of the market should we realistically expect to outperform today?
Yeah, we look set for some pretty sharp bifurcation, I think. Technology and other growth-oriented themes, often represented by, say, the NASDAQ futures, will likely be favored today. They tend to benefit most directly from that dovish Fed narrative, right? Lower discount rates help their valuations, and they also benefit from the overall speculative appetite that's confirmed by all this microcap activity. Conversely, sectors that are more sensitive to the real fundamental cyclically weakening economy, perhaps excluding those insulated by strategic policy support like LAC, they might face headwinds today or at least muted performance given the soft labor data and that underlying economic uncertainty.
Okay, so to quickly summarize the strategic framework then, the overall strategy today has to be one of intense adaptability, nimbleness. You have to be prepared for that inverted reaction function, especially around the 8:30 a.m. ET data release. This market does not seem tolerant of being slow or being wrong.
And crucially, here's an important point. While the CBOE VIX, the market's main fear gauge, is actually pretty subdued, it's trading down around 17.55, which suggests broad market panic is contained, probably because everyone believes in the Fed put. You have to recognize that this low VIX reading masks the underlying reality. Stock-specific risk is exceptionally high right now due to these violent catalyst-driven movers like CJT going up 180% and CHR collapsing 70%. The VIX reflects a sense of generalized safety maybe, but the daily market movers report reflects localized chaos. You absolutely must manage your single stock risk aggressively today. #outro.
All right, to wrap up our deep dive for this morning and maybe provide one final read on micro-level sentiment, let's quickly look at the pre-market earnings report that came out from Angiodynamics, ticker ANGO. This could provide a crucial insight into the broader medtech sector.
Yeah, Engo is a fascinating little case study this morning because of its recent history. It's actually maintained a perfect track record of beating consensus EPS estimates over the past year. For example, back in the quarter ending May 2025, they impressively reported a loss of only 0.03 cents per share, which was significantly better than the street's consensus expectation of $1.13.
Okay, but that history of consistent outperformance, it doesn't simplify things for today's earnings, does it? In fact, it probably makes the hurdle significantly higher because the market has likely already factored in their tendency to exceed those official expectations. So what is the official consensus for today's report?
Well, the official consensus EPS forecast for this quarter they just reported is $1.14. Now, on paper, that actually represents a significant year-over-year decline in earnings. However, because of that track record of beats, the market's real expectation, the unofficial whisper number, is almost certainly more optimistic than that $1.14 secure. So simply beating $1.14 probably won't be enough to move the stock positively today.
Right. So to actually generate a positive stock reaction, Ango basically has to clear a series of pretty difficult obstacles. What are they looking for?
They really need a perfect trifecta, essentially. First, yes, they absolutely must beat the official consensus of $2.14. Second, they probably need to beat that unofficial, unwritten whisper number too. But most critically, especially for the broader medtech sector sentiment, they must provide positive, forward-looking guidance. They need to signal a raise in their outlook for the future. A failure to deliver a strong upward revision in guidance, even if they manage to post a narrow EPS beat on the reported quarter, could easily lead to the stock selling off quite violently. The market clearly sees a deceleration risk in the sector, and any hint that they can't maintain growth momentum will likely be punished severely. So this Ango report serves as our final, important micro-level sentiment check for the entire medtech sector right before the main earnings season really kicks off.
Okay, so as the opening bell approaches, the strategic picture seems pretty clear. The market right now is rewarding narrative over reality. It's rewarding policy expectations over actual economic fundamentals. Weak economic data is somehow a reason to buy, and strategic government alignment is proving to be a source of explosive stock gains.
And that really leads us to the provocative final thought that maybe we need to carry forward from today. Considering the government's newfound willingness to take a direct, 5% equity stake in a company like Lithium Americas, a company explicitly deemed vital for national security, does the market now have to start factoring in Washington, D.C., not just as a regulator or maybe a customer, but as a strategic minority partner in certain publicly traded companies? What are the profound long-term implications for things like corporate governance, for shareholder rights, when federal industrial policy starts acting like a venture capital function?
That shift, that potential shift in the financial role of the state, is definitely a question that could drive market themes for years to come. Thank you so much for joining us on this edition of The Deep Dive. We wish you tremendous success navigating what looks to be a highly catalyst-driven market today.